Hello, hello. Hello, hello. You guys here? Sick. Oh, did I not share the link? Oh man. My apologies. I did not share the link to the Discord. I'm gonna give some people a bit to join in. It's been a while, guys. I'm gonna have to figure that piece out now. Trying to see. Like overall, what's going on? So we got a few things I want to go over. One of them specifically being markets, obviously, but also kind of just want to talk a bit about like what's going on. Like, who let this happen? I think some of the main pieces we're gonna go over today. We're gonna, I guess, we should probably start with what happened within the index, right? If we look at the index, S&P is down like 1.5%, 1.4%. The VIX closed at 15. It's almost like nothing's really going on. It's almost like nothing's actually going on. So I'm going to try to figure out what this even means. And we can just get right into it. For anybody, wants to rewatch this, or anybody joins in a bit later, feel free, just ask away on questions. But yeah, so I think the really interesting piece on all this is how, like, sorry. I think I'm going to kind of just preview what I was wanted to talk about. And it's this like macro and more report that I'm going to be releasing soon. It's a draft right now, but I should probably wrap it up after this. But effectively, it's macro and more, the week in review of what's going on, how positioning, how some policy is stepping into place, and what's happening in rotation underneath what's going on. Sometimes my streams directly correlate into a position as an opportunity and something that you guys can reflect into, or gain a bit of understanding yourself, and in other ways, like just kind of just get a piece of, oh, that's what's happening, got it, maybe I can look here, take a look here. And I want something to just be brought to the forefront of your minds in the first place, is that that's not the purpose of what this is. The purpose of this is really to do this. Is really to be able to like draw conclusions to be able to just show you where I'm thinking, and then be able to see how it plays out in the future, right? So that we can then, because all of this is cause and effect. Everything is cause and effect. Everything is, I noticed this happened, that increases the probability for this to happen. I noticed this happened, that decreases the probability for this to happen. And making that mind map of those things in your head continuously requires continuous and several hours and months and days of weeks of sessions of just being able to see that is occurring, and then capture a snapshot in your brain as to that leads to XYZ ABC, maybe 1 2 3, right? And the ability that you can do that and be able to recall those moments and go back to them, and then your speed and ability and agility to go back to those moments. Oh, last time I saw that this and this and this did happen. That is what's going to effectively help and truly double up, triple up your investments and the way you are in terms of understanding the markets, where things could go, where things may be going, and so on, right? So I guess let's talk about a little bit about the page, the week, and like what happened this week period. SP 500 closed pretty high, just below the 7.7. That's where hedging stops and we start kind of calming the market. The line, it didn't hold. Hedge funds actually ended up selling at one of the fastest pace since Liberation Day. That's why I saw, and I was like, I'm pretty interested in maybe going short here. But then I realized very quickly that idea didn't have much legs, and maybe that's a yet and not as of, doesn't have much legs at all. And we're going to go into that further, maybe where there is a structural short somewhere coming soon. And then 9 of 11 sectors were net sold, right? Pretty much only energy and consumer discretionary were bought up in terms of net bought up. Utilities also saw one of its largest selling weeks in the past 5 years. The story that I think everybody is really, really connected on as of late is what's happening with gold and copper, and more specifically and more speculatively, Bitcoin. And it's one of the first times actually that Bitcoin has become very correlated with gold. And usually they trade at a pretty low Z-score of correlation, like a 0.2 or like a 0.15, somewhere in there. But as of late, it's been trading at like a 0.7, which is almost a 1-to-1 connection. So that's been something super interesting. And we'll talk more about the common thread there that may be pulling on both sides. But gold and copper were the second and the third best performing thematic baskets. And that's pretty much it. And then we have the Operation Twist, right, where Scott Bessent basically came out and said that they're looking to add some liquidity to the longer end of the bond curve, right? So they're basically buying back their debt, right? So in that case, it's less payments that have to go outstanding in the sense. And because of that, they've like kind of reduced what is the longer term debt as the idea of to attempt to try and bring down yields. Now, it did seem to bring down the 30-year and the 20-year yields, but it didn't quite hold as the yields that were requested by people who want to buy were pushed back up recently. To kind of connect on 4, China's buying and how it really connects back to what happened recently with gold. And yeah, my particular position, at least to share a disclosure, I am pretty, well positioned within the gold and core metals complex as overall, expressed via equities and options. And I think I do find myself somewhere closer to the 5,500 per ounce as a target upside. Not necessarily something that that I think will happen over the next week, right? But I do think with giving it some time and some legs to grow, especially with some of the incoming catalysts that I'm going to also speak about this evening, I think a lot of that plays into it a lot, right? So what happened with the tape? The S&P finished down 1.4% this week, and the NASDAQ down, and the Nikkei down, right? All while the VIX kind of didn't really go to anywhere. 15 is not much of people pricing in fear. It seems like a pretty ordinary week, but if you looked into what the trade is, it's not very ordinary underneath it all. Goldman, kind of came back and noted that technology and media momentum fell roughly 18% from Tuesday to Friday in terms of overall like flow. Excuse me. The high beta movements have shown to be heavy decliners over this period. Think of the optics names, the semiconductor names being a few. Like they just haven't been able to catch a bid. Like they haven't been able to be even just slightly moving up. And the realized volatility is somewhere near 89, while the overall index itself sits below like a 13 kind of thing. So it's kind of the same story that we talked about in June. If you follow me on Instagram there, I spoke about what was happening overall and how the semi trade got a little bit too easy and too overcrowded and too hot, that it will be a very, very tough uphill climb for those guys to get back in the game and be able to catch some upside momentum. And kind of the overall, it seems like the S&P, maybe the S&P 470 is pretty calm to having a mildly positive scenario, especially with the breadth in the overall market kind of growing out and expanding a bit further into commodities now. And it's not just, high tech, hyperscalers, semi names as it is, and more, like I mentioned, commodities and other industrials, and even the builders and materials names kind of caught a bid, which they haven't really quite been able to as of recent because of partially home sales haven't been too robust as well. Price of lumber is still, at least to my understanding as of recent, still kind of going through a slump. It's a lot of volatility market sitting on top of what seems to be a rather calm one, right? So in plain terms, if you own technology heavy in your portfolio and you hedge it with the index product, maybe a IWM, a CP, a SPY, a QQQ, right? Or a VOO, you're less protected than what the volatility actually suggests. And that protection kind of fails when everything starts to fall together, right? So, and that's what forced selling generally brings, right? Because at this point, the high beta names and the hyperscalers are all trading in kind of the same direction. So it's kind of raised the realized correlation to a pretty high overall momentum. So utilizing the indexes as a form of a hedge or a defensive maneuver may not be as easy as it once was, per se, right? Where, okay, it's just 5 or 6 names that aren't doing too well, and but because AI has been so breathly, like kind of like in the sense that AI has gone so downstream that it's gone from chips to electrical components to building building materials, right? Similar to electrical components, to construction, Caterpillar, right? To companies like Siemens in Germany and what they're doing with their generator capacities, to even technology like Moderna, and they have a crazy 180% day because they've been able to utilize AI to give a potential specific gene therapy kind of vaccine or drug to a more advanced case of I'm not remembering the word of the type of cancer right now. But it just seems as if everything is interconnected with AI. Caterpillar has been able to find a way to go from a value stock to a growth stock because of AI, right? And because of that, that overall breadth that we're talking about hasn't been quite, the frame that we want. So yeah. So this is what we're looking at positioning wise. This is pretty interesting. This is one of the fastest selling periods that we've seen since Liberation Day. After buying US equities pretty consistently since late July, hedge funds reversed hard. Net selling ran at the fastest pace since Liberation Day, 2 standard deviations beyond what the 1-year norm is. Split roughly evenly between single stocks and index products. The net leverage fell about 3 points to 4.3%. The largest weekly decline in the 5 months and the 1-year low, and the short ratio fell to 1.6. And 9 of 11 sectors, as we've mentioned, were net sold, led in dollar terms by technology, industrials, utilities, healthcares, and even materials. Right? And in many ways, we do want this kind of, concentration to get checked, right? Like being one-sided too long doesn't quite, actually breed the ground of what is a conducive and positively growing market, right? Like GDP is expanding, sure. And it's just a matter of, is that sustainable? Is this expansion kind of sustainable? And I'm not here to say AI is a bubble, AI is a bubble. I'm not here to say that, right? And I do think that these moments are helping AI from being a bubble in a sense, right? Does anybody remember what was it, October? Where they were like, AI is a bubble, AI is a bubble. And then we got this leg up from basically November, December into what is now, right? Like all through everything, all through Iran, all through tariffs, all through a potential private credit issue, what we had over there with the First Brand scenario that started to get all through Oracle credit default swaps and what they went through. Like we've been through a lot. And what was defined as a bubble back in 2024 seems to still be kind of going along. And that's honestly the greatest debate right now. Is it a bubble? Is it not a bubble? If it is a bubble, then why hasn't it burst? Or what will be the burst, right? Earnings revisions are showing up. So yes, in essence, companies are getting cheaper on a price to earnings ratio point of view. But some people are arguing that it's an earnings bubble as opposed to what is considered an AI bubble, right? Where companies that are spending tons of money on Caterpillar and their equipment and renting that out for data center build-outs, that there will become a time where we've built enough data centers potentially. That's what they're saying. And we won't need more. And whatever Caterpillar booked in free cash flow a few quarters ago, maybe, may very quickly be cut in half. Because of how concentrated those cash flows came in, right? Where'd they come from? So I like to kind of put in these gut checks to be like taking the other side of the argument. It shows that yes, we're heading lower, right? Net exposure is already at the bottom of its 1-year range, which is kind of contrarian, right? It's like if we're already grossly under leveraged. Oh, sorry, gross leverage went up 205%, and it sits at a 72 percentile in the fight, right? So we are a bit leveraged, but they're hedged, right? And that distinction matters. A book that has a owner that has a bunch of cash can redeploy that cash, and a book that has hedges can unwind hedges, and it can do that slowly. And once the move's over, guess what? You have another set of dry powder to go take it back up, right? So I feel in many ways, we are more prepared now in terms of market structure and where we are than we have been for quite some time to be able to withstand, a gross deleveraging event or something like that. Right. So, like we said, S&P didn't hold, the core level broke, all that stuff. I don't really have too much here because the VIX is super low. I mean, yes, we're heading lower, but we also have so much coming down the pike that it makes sense that we're kind of just doing nothing in that point of view, right? Where we're, down 7%, up 4, down 3, up 4, down 5, up 3, right? Like, I feel like we're kind of chopping around here after the all-time highs from July or June, right? So if we take a look now into what happened with the bonds, Treasury bonds, right? The Treasury needed to try and stabilize the long end. So they figured, hey, if I buy back more on the long end, it could lower the percentage rates, right? And they did something similar to this too, just a few days, maybe a week or so prior, with Japan to try and help them with what they've got going on with their currency. And it didn't work. I think they did a $10 billion yen intervention, and market took it, went lower immediately, but by the next session, prices were back to where they basically were before the $10 billion buy, just effectively absorbing the entirety of it. And that kind of similarly happened here, where they mentioned that they're going to increase the bond buying from a $2 billion repo position into $4 billion. Well, the bond market's like, what, 25 trillion or something like that? So when you look at it in the grand scheme of things, it's not that much of a difference. And that's pretty much why we saw it kind of give out. Because you really only came in and gave a small portion of liquidity from the larger system, right? And yeah. And the Goldman's desk read that the signal as a change in reaction function rather than a change in rates, and suggested that more lasting consequences really could show up in the dollar and in gold rather than in the bond market itself. And that's pretty much what happened, where gold decided to improve meaningfully as the US Treasury effectively, devalued the US dollar. Maybe not to a literal grand scheme amount, but in essence, in theory, in willingness to, right? They devalued the US dollar. Because not only that, but they mentioned 4 billion, and then they added a caveat of they're willing to do more. How much more? 10 billion? 100 billion? 3-4 trillion? Right? Like, what is more? So they kind of left that open in the air. So that's something to think about, right? As, does this quantitative easing become more, right? And then what does that do for assets, right? So we know a down dollar means hard assets up. Gold, copper, right? And even value stocks more specifically. And on the other side is that trend followers remain meaningfully, they hold short amount of global bonds, government bonds rather. And they're really just trying to kind of get back to it a little bit more. I don't know. I feel like this topic's been covered a lot, but I just kind of want to bring that to you all, right? When yields are up and not down, it pushes the trend followers further into the money and to buy cover levels, right? And these types of things and events change my positioning where the stock's trading at $50 and I'm looking to put on a long position potentially. And I may usually go $52 strike on the call, but this time at trading at $50, I may go to 48 strike and just add a little bit, more duration into this scenario so that I could be a bit more tactically defensive in a pullback if things do get a little dicey, right? Where a position that may be down 30%, if I went the out the money route, is effectively down 12% in the money on the same delta move of the underlying asset. And I could be a bit more defensive of my cash in that way. So, I mean, that's just one thing, right? And what's happening is it's pushing this further. So I guess the gut check, really, this is a squeeze setup, but the trigger hasn't quite fired this week, and argued against it. But yields went up, not down, which pushes the trend followers further in the money and further from their buy levels, right? And it requires a catalyst that pulls long-dated yields a bit lower. And the obvious candidate, an official buyback program, has been just tried and rejected. So that's the strike at the near-term version of this trade. So what survives is that in the longer observation, when an issuer intervenes to manage price and of its own debt and to push markets back, right, the pressure is released somewhere else, right? So it's kind of the belief of a lever. Or in other cases, really a pendulum. You guys know I know I like talking about pendulums a lot. So there's that. That's for sure. So yeah. So we got two major events this week, I think, honestly. We got NVIDIA reports Wednesday, and then I also think we have PCE revisions Wednesday, which I don't think is going to be too important, but NVIDIA reports Wednesday. It's going to be a big cluster of what is AI right now? What are they investing in? How well or how poorly the company is doing? And I would say right now, it'd be much, much more of a downside surprise than an upside surprise. And we know that, right? We know that. But the overall artificial intelligence complex has been sold hard, right? Is it going to continue to kind of, sell hard? Whereas we have some other names as well reporting on Wednesday. Zoom, Intuit, and Tuesday, rather, actually. HP, Okta, CrowdStrike, Salesforce on Wednesday, Workday, Marvell, and Elastic on Thursday. Marvell is pretty big as well, right? So I would watch to see some synergy between NVIDIA and Marvell as they are both very heavily correlated in the AI industry. And then even this HP with server racks and potential what can happen there. And then we got Jackson Hole, where I'm hearing Warsh is speaking Friday morning. Definitely something you don't want to miss. July employment data and inflation data, I believe, is going to go over. It's going to be one of the first talks that he has outside of the FOMC event. I'm actually just kind of happy that he's even going to an event because his point of view is they want less conversations from the Fed to society, which I'm not quite a fan of because, I mean, okay, hold on. Let me rephrase that. I'm a fan of letting the markets be free, right? But I'm not a fan of this like laissez-faire approach to what's going on in markets, right? And that kind of goes as well with the idea of, oh, we don't need earnings 4 times a year, and companies, should be optionally reporting earnings. I don't think I want my money in assets that I don't know what the heck's going on in them. I think fairly and plainly that, right? And if it's some form of accounting rigmaroles, fine. Let me read the SEC filings and determine that myself if I want to hold it. Not take it away from me and then say that it's just not needed. It just creates no, bro. I don't quite see the justification for it. And I get that, like I said, I get that, companies do their little dance and rigmaroles to hide the earnings and the losses and the EBITDA, and then they adjust the EBITDA. I get it, right? But I'd much rather know what the actual revenues are. Like, still, I want to know what segments of the business are growing, which ones are failing, how well are they paying down their debt, right? Like, there's still so many other things that aren't just adjusted EBITDA or earnings per share that are shown within these reports that I feel are very, very undervalued by the street. And a person like myself who's searching for every single misbalance or something as an opportunity, more information the better. I'd rather drown in information than have to cry looking for something to tell me something. So that's kind of my point on that. And to go back to the comment of laissez-faire in the sense of, well, yeah, like in the full sense of like, oh, like, we're just going to let the markets do its thing. They don't have to report earnings. Like, I don't think that tells me that they don't. Like, I don't think that a company not having to report earnings absolves them of doing what is necessary and what is right by the company and its shareholders. And the way that they're putting it is that it will be, right? It will be at ease for the owners themselves to do. Like, listen, like, you're in that role for a reason. If you can't handle the heat, get out the kitchen. And if there's some other like truth or some other plan, let me know. I'm here. I'll gladly listen to it to see what they're talking about as a replacement to earnings, not being out. But I want to know what's happening with the company, and I want to be able to read it myself. And I want to be able to judge for myself. Simple, done and dusted. So we got this rotation. We got market beta, from beta towards balance sheet, right? Where I'm seeing a lot of, right, these beta companies, internet service providers, IPPs, sensors, opticals, drones, neo clouds, right? into what is, more value, copper, mining, and drugs. I mean, I guess I own a little bit of Bitcoin. But that's really just because this guy will jump on any type of news. Like any type of good liquidity news there is, right? And that's why I think all this is, where I just mentioned how that the correlation between gold and Bitcoin finally found its footing together. It's liquidity. I don't know exactly where in the liquidity it seems to be kind of found or caught up on, but I think it's within the quantitative easing cycle that creates this Bitcoin bullish backdrop over and over and over. Like let's just talk about Bitcoin from 2021 to 2020, like into 2023, 2, right? And then there's other mechanical things that happen within that, in between those periods, to create other bull sectors, right? Like the halving events and so on. Those types of things. Right? Excuse me. So let's take a quick look at that then. I actually want to touch base on Bitcoin. Like, let's just look at it from a technical point of view. I'm gonna say a one sentence and one sentence, pretty much only. Oh. Expansion, hyperinflation, further expansion, retest of expansion into what could potentially be further expansion. That's it. That's quite literally it. And this is a visualization of the gross negligence of the balance sheet of America. Every single day they come out and debase the dollar, and the value of your dollar continues to fall through the roof. Other assets continue to increase in value. Other assets that could be really used as currencies, as well as assets that tend to appreciate. That's it. That's literally it. This is the dollar. As the dollar stays below 100, we are golden. In the sense that what's currently happening will continue to occur. Gold will continue to find new highs potentially. Bitcoin will continue to find new highs, right? Commodities will continue to find new highs. And I've even just made a new list. Oh, man. COMT. Look at the commodities ETF. COMT, y'all. What a beautiful base that it broke out of, came back, retested the top of the base, and pushed back out. So this commodities dynamic index, or dynamic roll index, actually holds bonds and performing 40% year to date. Like with a 5%, a 5.5 dividend, value is the trade. Value. The compounding names, right? So for quite some time, we've seen this is always a constant battle. Growth, value, right? And if you don't know what those two are, I'm gonna break it down right now. Ready? Growth names are names that aren't there yet. They aren't companies that are the one, right? They are working towards becoming the one. And a lot of times they're either in the early stages of development, they are maybe even pre-revenue, they are maybe post-revenue, but can't find profitability because they have to subsidize their revenue, right? Think Uber early days, where Uber was $7 just because they just wanted people to try it because nobody was used to the behavior or used to the point of view of just getting into a stranger's car to drive you somewhere, right? So what they had to do, they had to lower the price of it, lower the entry price to make it more appealing for the individual to then be able to begin the cycle of ingraining in your brain that it's okay. And now, I'm pretty sure most of us can't quite fathom a world without an Uber. Oh, I needed that Uber to get me from there to the airport. What would have happened if that happened with this? Right? What would have happened with such and such? I also can't see the chat for some reason. I'm sorry, guys. So I don't know what to do with that. But I can't seem to see the chat. Hopefully I'm not missing out on some juicy stuff, right? So if you really think about it, you're like, wait, you mean to tell me I could have grabbed 40% on just owning commodities this year, all while getting a 5.5% dividend? Listen, that's monstrous. And growth, right? Growth has a place, right? Where a lot of times the value creation occurs in the underlying price asset, right? Where you maybe bought a stock at $10 and 10, 15 years down the line, it's $100. Wow, that was beautiful growth, right? And because it was able to grow into a company looking for product market fit, looking for its consumers to be able to like agree with and sit down with, and it was able to find it. And they were able to continually come back, and then the product grows and it becomes a verb, right? Catching an Uber, you're gonna DoorDash some food, right? Once it becomes a verb, that's when you don't really get out the house yet, right? You're maybe not immediately into value because you're not a compounding cash flowing machine yet, but you've been ingrained in the generation psyche, right? So much so that roughly by the beginning of the next generation, or even at the latter end of that initial generation, you will then transform into what is a value name. And what is considered to be a value name? Think Waste Management. A company that is so entrenched in our system and in our society that the same cash they made last quarter, they might roughly make the same one again, and roughly make the same one again, and because we still need our garbage taken away. Or think of a Coca-Cola, a company that's so massive that it even has a massive global footprint, so much so that it's hard to really throw a wrench in that kind of business. It's just going to continuously compound over and over and over again. And the share price may only go up 100% in 8 years, 7 years. But it's also spewing a beautiful dividend while doing such. Imagine if it didn't spew that dividend and it reinvested the capital instead of giving it off, right? So it's really the growth to value conversation is simply just the act of of equities maturing into a full-fledged business, right? It can do it over and over again, right? And a lot of times people who even are new to the markets or stepping into the markets get brought in by the glitz and glamour of a growth name, of a fact that SanDisk went up whatever 170% this year, or what even is, I don't even know what they did go up this year. Something crazy, right? They're brought in from that point of view, that they're looking for that kind of thing to occur, right? They want a 355% gain over. They want to catch Moderna do something stupid and they want to do that. And they want to do it so bad that they end up chasing this fleeting kind of premise that that's what markets are, right? Because it's going to happen in a week. It's going to happen in a month, right? And they end up ditching potential growth names in their infancy stage. You didn't even give that company the chance to grow up and mature and show you what it could do in its career, right? Imagine owning Tesla in 2012 and then seeing him about to go bankrupt. I think it's 2012. Seeing Elon about to go bankrupt, or Tesla about to go bankrupt, and then just ditched it immediately. You weren't able to reap the benefits of the shares finding their way to $362 a share. And this is post split, right? I think it's done like 2 splits since, right? And in many other ways, some people's personality just kind of aren't conducive for that type of emotion. The fact that a company can be an infant and it goes to basically the bottom, and then has that team and the corporate team have to find a way to dig themselves out of that to then potentially grow into what becomes a staple. Because sometimes that happens in a quick shot. And then other times you look at NVIDIA and look at that. I think the company was founded in like the late 1990s. They haven't won until right now, basically, since 2022, roughly. 2023, really, I think it was when NVIDIA really, really took off. It was always doing like relatively good though, right? But so in other cases, some people may just need to be value buyers. Yeah, I'm gonna buy that existing company that's already doing well and continuously cash, right? And now the dynamic switches. The dynamic switches from I'm here to focus on how this company can grow into a massive company, and that's the growth side, right? And I'm willing to be patient enough to be able to endure that. And then there's the other side of I'm gonna invest in this company that's well established, and I'm gonna buy it at a really decent price as well. The cash to how much cash is gonna be able to generate me. And because I'm buying at this decent price, it's gonna be able to give me some good dividends. And I now need to just watch over, what could be in the way of interrupting that. What could be coming down the pipeline that could interrupt that? Yeah. So yeah. Look at commodities, y'all. Wow. What a monster run. And honestly, I don't see where this freight train's stopping. But then let's take a look and let's see what's in it. Bonds. Just straight bonds. First, it has treasury shares, 15% of it. And another bit of it is cash, almost 12% cash. Excuse me. Then more treasuries. Then more treasuries and more treasuries and more. And then FPL bond. You more treasuries and then more bonds. This is all debt. It is all debt, y'all. More treasuries. PPG Industries, extra storage, debt. It's just buying debt. Guys like Howard Marks probably had an amazing year. Amazing year. Wait, did I just see Bank of America in here? Are those shares? No way. Oh, wow. Bank of America shares. Royal Bank of Canada bonds. Not expiring until, wait, 2026. This should have expired. What are these doing in here? I mean, it doesn't change the case that it's all basically bonds. Charles Schwab bonds, but it's pretty interesting that maybe they matured. Oh, that's the accrual date then. Wait, which one was I looking at? Look at the FP&O one. Let me see. Oh, I could just do this. Yeah, maybe Trading View just needs to update it then, because the fact that it's not already here, it's not here, means that those pieces didn't update. Verizon. Is this also bonds? Yep, the Verizon bonds maturity is expired. It's maturing very soon, actually. More T-bills. Yeah. This is just crazy. So, I mean, a lot of this is to just kind of show what the gut check is, so that you guys understand that not everything is always up and to the right on these equities, guys. And not saying that we're going to go back into that place where, in 2022, things didn't, do so great and it was struggling. But if we look at charts, guys, in 2022, commodities did amazing for like that first half of the year, roughly, before they hit the wall. Right? And if we map it out across, let me try and map it out. If we map it out across what we have here, let me just do QQQ. Make an overlay it maybe. Right? You see the inverse reaction, where this line is QQQ, the blue line, and the commodities are the candlesticks, rather, right? And you can see how it came a point where, oh my gosh, can you just stop? You can see how it came a point where they were trending together and then they diverged, right? And based on where we're going, based on the upcoming catalysts, if we see the Fed tightening even further, I can see how commodities continue to rally, risk assets continue to fall, right? More specifically, IWM, right? They're the more rate sensitive sector, but also more specifically the semiconductor side, because even though we have had a lot of selling, there's still a lot of gross leverage. I showed you that we talked about. It's over 200% in gross leverage sitting in long assets. And ultimately, that's going to continue along the side of booming energy prices, right? Booming, let me see. does XLE compare to this? If I were to put this on the same scale, look at XLE. Look at energy over the same time period. It moved basically right along with commodities, slightly faster, right? Like these years, this like into 2022 into 25, this period right here was a bit more flat for commodities, whereas energy had a nice, a nice curve slope to its appreciation before continuing that expansion out. And these are just the parts and the pockets of the market that I'm watching. Watching more on bonds, and I'm trying to gain more historical context as to what happened when this happened. Back when? Oh, what about the period of '87? Right? I believe there was a flash sale in '87, where, let me remember this properly. Where it was a decent amount of selling. What was it? What was it created to? Oh, Black Monday, '87. That was more, computer kind of things where the computers were really starting to take over, in terms of programmatically putting things together. But portfolio insurance, staples, the strategies that kind of triggered a massive crash, cascading orders, selling. That's more of a structural issue, I think, that happened. But the aftermath was that the Fed quickly injected liquidity into the system to be able to stabilize the banks and restore confidence. They also did bring in circuit breakers. That's what it was. They brought in circuit breakers to be able to halt markets, so that it couldn't be able to do that any longer. Yeah. But this is the part that's also really interesting. You see how they said that the Fed increased liquidity to, stabilize the financial system? Why is the Treasury increasing liquidity to stabilize the financial? Wait, but I thought we were great. I thought everything was amazing. We're at all-time highs, right? Interesting. And they're doing this before we crack, right? Before we see some type of a pullback, right? And again, I'm not a bear. I still like the markets to the upside. It's just how much of that upside, how dramatic will it be, and how withstanding is it from here? I don't know. We may find our way in a period where we kind of chop along for a little bit, especially while more things become in place. Now, in the shorter term, the things I'm hearing that the Strait of Hormuz is finally letting some ships through. I don't know if that's true or not. We'll see. Maybe the market believes it, maybe it doesn't. Oh wait, futures are open. It's already 8 o'clock. What do futures look like? Gold is up 1 basis point. I'm dead. NASDAQ, 27 basis points. Everything is slightly up. Bitcoin's basically flat. Like nothing's happened. Flat. Metal's slightly down, 20 basis points. Like nothing's happened, honestly. Natural gas futures is up a percent and a half almost. Let's see. The price of crude, though, is down 1%. So it does seem to be, the market as of right now does seem to be believing that Trump and his team kind of put something in order to help out with this Strait issue as of right now. So we'll probably see some pullback there in long energy names. How sustainable that is, I don't know, because we live in we're currently just living in a world. But yeah, I mean, just try to take things day by day. Don't shoot at everything you see. And when it really, really, really lines up, knock it out the park. That's pretty much it for me this evening. I will be, sharing some other materials here. If you found this stream, you probably know how to get in contact with me. So I'm going to be dropping some other pretty cool reports and things very soon. So, alrighty. Catch you guys in the next one, yeah? Peace.